I am meant to be doing an 80k bike ride right now, but it's raining outside. Apparently there's a storm and thunder coming. So instead I just sat down, planned out 4 videos, including today's one. So next week you can expect a video on how investment banks make money, how to make the most of your 20s, Goldman Sachs Asset Management buys NN Investment Partners. Those are videos that are going to come out on Wednesday, Friday, and Sunday. But anyway, let's get to this video. What's going on, people? So last week we spoke about how Elon Musk is using investment banks to finance the purchase of Twitter, which is priced at $44 billion. Alright, so initially the plan was half of the $44 billion or so was going to be financed with cash, and the other half was going to be through debt financing and a margin loan. So basically putting up Tesla stock in order to get a loan where the stock was used as collateral, and then half of it was going to be like a traditional loan that you and me might take out from a bank. If we want to buy a house, he would take out a loan from a consortium or a number of investment banks. However, since publishing that video, a lot has changed, but now half of that $12.5 billion, so $6.25 billion, is going to be used as a margin loan, and the other half, so he's raised about $7 billion of equity financing. So before we had cash, we had debt financing, but now we've got equity financing thrown into the mix. So this is where it gets interesting. He's raised about $7 billion in equity financing from a number of asset managers and venture capital investors. Now, you're probably wondering what's the difference between equity financing and debt financing. When you're taking on debt financing, you are basically in debt. You need to repay that money, and oftentimes you need to pay interest on top of that money because of the opportunity cost that you're taking up from taking that money from the lender, right? So debt financing is you take loans, you pay interest on top of the annual or monthly payments you are contributing to pay off that loan. The difference with equity financing is you're not taking out a loan. Someone, a company, venture capital firm, an investor is giving you money, and in exchange, instead of interest and repayment of that loan, you're giving them equity. You're giving them a part of your company. So it depends. If you don't want to give up a part of your company, maybe debt financing is better for you. If you're happy to give away some equity or part of your company, then you should pursue equity financing. That's the main difference. Typically, when people are going for the equity financing route, the investors are hoping that the equity or the stock is going to go up in value over time. And so that's their risk that they're taking. It can either go down or it can go up. And the person, or in this case Elon Musk, he's hoping not to go into more debt and rather give part of Twitter to these equity investors. And so that way he doesn't need to make repayments back in the form of monthly or annual payments and interest. So now what this does for the whole $44 billion, it means there's a cash portion, there's debt financing portion, which includes a traditional loan and margin loans, and then you've got the $7 billion in equity financing. All right, so what impact did this have on Twitter's stock price? So initially Twitter's stock price went up a bit. However, so the price that he's buying Twitter at is around $54. And Twitter's share price has been hovering around $50, slightly below what he expects to buy it for. And the reason why it's trading below the price that he's buying at is because a lot of investors don't believe the deal is actually going to go through. And if it doesn't go through, Elon Musk is going to have to pay $1 billion. $1 billion isn't a lot to him, but $1 billion is a lot in the grand scheme of things. But yeah, we'll see whether it goes ahead or not. In terms of the new $7 billion, it's come from a range of investors. One of the investors sits on the board of Tesla. They've contributed $1 billion. One of the investors are Sequoia Capital, major venture capital firm. They invest in high growth tech companies, startups, so on and so forth. As well as the founder, I think the founder of Binance, so big cryptocurrency platform. He kind of said, yo, look, there's a blank check on this. Whatever Elon wants to do, we'll back it. We'll put in as much money. They put in $500 million. So there's a lot of people who believe Elon will take over Twitter and improve it and make it better, and thus getting them a good return on investment over, 5, 10, 15 years, however long it might be. And then 2 other investors include Qatar's investment fund or sovereign wealth fund, the QIA. They're putting $375 million into the investment. And then you've got Saudi Prince Al-Walid bin Talal bin Abdulaziz Al Saud. Said it right. He's already an investor in Twitter. He's rolling over, I think, 35 million shares, which equates to $1.9 billion as part of that $7 billion equity investment. Now, keep in mind, you've got venture capital firms who are investment firms who provide money to startups, scale-ups, high growth companies. They are very, they risk loving. They are very high on the risk appetite. spectrum. And then you've got private equity firms who invest larger sums in bigger, more established companies. As part of this deal, a lot of private equity firms kind of stayed away from Elon Musk taking over Twitter. And the main reason for that is typically when private equity firms are taking over companies or investing in companies, they want to deploy their employees or their people to go and kind of run that company or have a strong influence on the board. Private equity firms didn't bother getting involved as much with the Elon Musk and Twitter acquisition because they didn't believe they would be able to kind of have an influence on Elon Musk and his decision making in growing, building, and just, you know, taking the company to the next level. They probably thought they won't be able to influence him much, and so they stayed away. Whereas venture capital firms, they invest money into companies and they kind of let the founders do what they want. They believe in the founders. They don't have an active role in going in and changing the operations of businesses as private equity firms might do. So keep that in mind. All right, so what does this mean for the investment banks? So Morgan Stanley, Goldman Sachs, and a few others, I think 12 in total, were coming together to put together $12.5 million in margin financing or a margin loan, where the collateral would be Tesla stock. However, this $12.5 billion has been cut in half to $6.25 billion. They're still going to make a lot of money, but Elon Musk has just said, you know what, I'm not going to borrow $12.5 billion from you guys, cut that in half. And that's it. So investment banks lose out in that sense. However, it's still a huge deal and they'll make a lot of money from the deal. However, that is if the deal goes through. So there's constantly been ups and downs throughout this whole Twitter acquisition. 2 days ago or so, he tweeted that there's too many fake accounts on Twitter, and so it kind of threw a spanner in the works. People are questioning whether the deal is going to go through or not. Some people believe that he doesn't want it to go through because it's the $44 billion that he's paying for it is too much. People think it's overpriced. But time will tell what happens. If you like these topical news, current affair updates, stay tuned because next week we're going to talk about a big asset manager acquiring a smaller investment firm who is a specialist in a specific segment of the market and why they're going to be doing that. So I will see you in the next video. Peace.